All right, if you've glanced at your investment portfolio lately and wondered why the markets are just behaving so differently than they did, say, a decade ago, well, you are in exactly the right place. Today, we're unpacking a massive structural shift that happened back in 2026. We're talking about the invisible, hyperfast digital architecture that quietly but literally consumed Wall Street from the inside out.
So here's our roadmap for this explainer. We're going to cover Wall Street's AI upgrade, look inside the AI machine itself, trace the road to full autonomy, see exactly what this means for you, and finally, look at the very real risks of AI trading. Let's just dive right in. Okay, part one, Wall Street's AI upgrade, or as I like to call it, the end of the human market maker.
Think about this for a second. When you open up your brokerage app and you hit sell on a stock, who or what is actually on the other side of that trade? Decades ago, sure, it was some sweaty guy yelling on a crowded trading floor. But today, it is an entirely different beast altogether. We're basically living in the era of AI-managed liquidity provision and generative options gamma. Sounds complicated, I know, but it's actually fascinating. Basically, specialized AI models now sit right at the intersection of generative computing and high-frequency trading. Their entire purpose in life is to neutralize wild price swings in real time. They make absolutely sure that instant liquidity is always waiting for you the second you click that button. Now, you've probably heard the term gamma thrown around a lot in finance. Honestly, the easiest way to picture it is just by thinking about your car. If delta is the speed you're currently driving, then gamma is how fast you're pressing the gas pedal to accelerate. The AI's whole job is to constantly predict and manage that acceleration risk, so the market doesn't, crash straight into a wall. Moving on to part two, inside the AI machine, where the math happens in literally microseconds. So here's the cycle, and it is happening endlessly. First up, generative models are creating millions, literally millions, of synthetic what-if scenarios every single second, just imagining brand new market conditions. Instantly after that, the AI assesses the real-time gamma risk, calculating the exact market acceleration if a stock moves by even just a single dollar. As that risk rises, it automatically executes offsetting hedging trades. And finally, it injects liquidity by placing buy and sell orders right where demand is predicted. All of this, it happens in a tiny fraction of a second. Of course, it takes a massive, massive ecosystem to actually run these simulations. You've got generative models built specifically for financial time series data, huge banks acting as market makers, regulators constantly monitoring for flash crashes, and, this is the big one, colossal data centers. Fun fact here, a lot of these cloud data centers are physically built as close to the actual stock exchanges as humanly possible. Why? Literally just to save a few microseconds of fiber optic travel time. It's wild. All right, part three, the road to full autonomy. How we actually handed over the keys. Now, we didn't just surrender the global economy overnight, right? It was a deliberate four-phase process. First came the backtesting, where firms had to prove the AI could beat humans using historical data. Then, human risk officers stepped in for model validation, rigorously inspecting the code for illegal biases. From there, we entered what's called the human-in-the-loop phase. This was basically traders babysitting the AI, having to manually approve the really large trades. And finally, once that trust was totally cemented, we hit full autonomy, 24/7 gamma management with absolutely zero human intervention. Just think about the incredible domino effect here. When large banks integrate this AI, you get these microsecond hedging reactions. That needs to stabilize Greeks, meaning the gamma is controlled, which directly drops overall market volatility. Because the AI buffers these crazy price jumps before they can even fully materialize, the massive secondary impact is cheaper insurance and, crucially, rock-solid stability for everyday things like your pension fund. Which brings us to part four, what this means for you, the actual real-world impact. So the practical implications here really depend entirely on who you are. For individual, everyday investors, you get a much smoother ride. We're talking stable prices, much lower spreads, and reduced fees. But for professional traders, well, those old-school button-clicker jobs are just completely gone. They've had to evolve into what's now called AI orchestration and model supervision. Ironically, the real wolves of Wall Street today are essentially just algorithm supervisors. And all of this insane capital efficiency unlocks basically the holy grail of modern trading, T+0. Because the generative AI instantly verifies and balances the books, instant settlement is now the absolute standard. Your trades clear immediately, and the big banks can provide massive, market-wide liquidity using just a tiny fraction of the physical cash they used to need. Okay, but we have to talk about part 5, the risks of AI trading. There's always a catch, right? Look, this system is absolutely not invincible. Far from it. Think about it. Just like a chatbot can hallucinate fake facts, these financial models can hallucinate too. They can invent fake market trends that simply don't exist and execute rapid trades based on pure fiction. Then you have the whole black box problem. During a sudden crisis, it is nearly impossible to look under the hood and explain exactly why the AI made a certain decision. Combine that with the massive concentration risk of a potential market freeze, plus the literally colossal amount of electricity needed to run millions of simulations a second. Yeah, the financial sector's carbon footprint is spiking heavily.
To wrap up this explainer, I really want to leave you with one provocative thought. What actually happens to global liquidity when every single firm's generative AI model decides to sell at the exact same microsecond? That right there is the ultimate concentration risk. The machines have given us unprecedented stability, for sure, but they might have also created a massive single point of failure that we're only just beginning to comprehend. Definitely something to think about the next time you check your portfolio.